Something just broke in the global silver market, and if you check prices right now, you'll see it with your own eyes. Physical silver in China is trading at $90.25 per ounce. At the exact same moment, COMEX futures in New York, the supposed global benchmark for silver pricing, are showing $75. That's a $15 gap. A 20% difference between what silver actually costs when you're buying physical metal that you can hold in your hand versus what it costs to trade paper contracts that almost never result in anyone touching actual silver. And here's what should terrify every investor watching this. That gap was only $8 2 days ago. On December 24th, Shanghai Physical was trading at $78 while COMEX showed $72. Now it's 90 versus 75. The gap isn't closing. It's exploding. It nearly doubled in 48 hours. And that acceleration tells you something fundamental is breaking in real time. Before we dive into what this means and why it matters, I need you to do something. Pause this video right now and check the current China physical silver price and the COMEX price. Write both numbers in the comments below with the timestamp. Because when people look back at this moment 6 months from now, when this situation has either resolved catastrophically or Western prices have been forced upward to match physical reality, you'll have proof you were here at the beginning. And if this kind of real-time market analysis is valuable to you, smash that like button right now. Let me show you exactly what's happening, because this is the most important commodity price signal on the planet right now. The price you see from China physical silver markets shows the price for raw physical silver today at $90.25. That's not a typo. That's not a data error. That's the actual clearing price for physical silver in Chinese markets where factories need to buy real metal to manufacture solar panels, electronics, electric vehicles, and smartphones. Meanwhile, COMEX is showing $75. That's a $15 premium for physical delivery in China. Think carefully about what that means. In the world's largest silver-consuming market, where over half of global industrial silver demand comes from, they're paying $90. In New York, where traders shuffle paper contracts back and forth with no intention of ever taking delivery, the price shows $75. Which price is real? The one where metal actually changes hands and gets consumed in industrial production, or the one where contracts get cash settled 99% of the time without anyone ever touching a bar of silver? Now here's why this matters more than just a price difference. On December 24th, just 3 days ago, the AG spot contract in Shanghai settled at approximately 19,400 Chinese yuan per kilogram, or $78.55 per ounce, significantly above the global benchmark on COMEX, which closed at $72.36 per troy ounce. That was a $6 gap. Within 48 hours, that gap has expanded to $15. Silver in China has jumped from $78 to over $90 while COMEX has barely moved from $72 to $75. What does that tell you? It tells you that physical demand in China is absolutely desperate. Chinese manufacturers, solar panel factories, electric vehicle producers, electronics makers, they're not waiting for prices to come down. They're paying whatever it takes to get metal right now because they need it. And the premium they're willing to pay is accelerating upward. That's not normal market behavior. That's panic buying driven by physical scarcity. Let me explain what's driving this shortage, because this isn't temporary and it's not going away. China's silver backwardation is rooted in several key factors, including multi-year lows in silver inventories and a surge in industrial consumption. By November 2025, silver stockpiles on Chinese exchanges had fallen to their lowest levels in years, driven by robust demand from domestic manufacturing and export sectors. The solar panel industry in particular has seen explosive growth, consuming significant quantities of silver for photovoltaic cell production. China produces over 80% of the world's solar panels. Their government has mandated renewable energy targets extending to 2030 and beyond. Every single one of those panels requires silver paste for electrical conductivity. There is no substitute. You cannot build a solar panel without silver. And as China pushes aggressively into renewable energy both for domestic use and for export, their silver consumption is structural, locked in by government policy, and growing every quarter. This isn't speculative demand that might disappear next month. This is industrial consumption baked into China's strategic economic plans for the next decade. But solar panels are only part of the story. Electric vehicle production continues to rise. Each EV uses significantly more silver than a traditional car, particularly in power electronics and charging infrastructure. Battery electric vehicles use twice the silver of traditional cars. As manufacturing of EVs expands globally, as governments mandate the phase-out of internal combustion engines, silver demand from the automotive sector is exploding. Then you've got rising defense spending linked to conflicts in Ukraine and the Middle East, which has increased demand for silver in military electronics and munitions. AI data centers being built across China and globally. Every server, every cooling system, every electrical component requires silver. The technological transformation we're living through, the shift to renewable energy, the electrification of transportation, the build-out of artificial intelligence infrastructure, all of it runs on silver. And we're consuming it faster than we can mine it. Global supply constraints have also played a role. Labor disputes and environmental regulations in key silver-producing countries, like Peru and Mexico, have limited output. These production bottlenecks have reduced the flow of silver into China, intensifying the supply-demand imbalance. Now here's where this gets really dangerous for the entire global financial system. With a $15 gap between China and New York, you'd think traders would be rushing to buy silver on COMEX, ship it to China, and sell it for an instant $15 profit per ounce. And you'd be right. That's exactly what some traders are trying to do. But here's the problem. Every time a trader pulls silver out of a COMEX vault to ship to China for that $15 arbitrage profit, there's less physical metal available in the West. But the number of paper contracts, the promises to deliver silver, doesn't decrease. In fact, it often increases. So you end up with more claims on silver and less actual silver sitting in vaults. That's the mathematical setup for a delivery default. That's how a major commodity exchange ends up in the catastrophic situation where they cannot deliver the metal they promised to deliver. And we're starting to see the stress in real time. Banks had to pull $17 billion from the Federal Reserve to pay their margin calls on their silver shorts. $17 billion. That's not a normal day in commodity markets. That's emergency liquidity being tapped because positions are blowing up. Let me break down what this $17 billion withdrawal means, because this is the smoking gun that tells you how serious this situation is. While everyone watched silver rip to $79, the real smoking gun hit the plumbing. $17 billion tapped from the New York Fed repo window the Friday after Christmas. An emergency cash grab that screams margin stress. When banks need to pull that kind of money from the Fed's emergency lending facilities, it means their silver short positions are underwater and they're facing margin calls. A margin call is when your broker demands you deposit more cash because your losing position has gotten so large that your initial deposit isn't enough to cover potential losses. If you can't meet the margin call, your position gets liquidated. You're forced to buy back your shorts at whatever the current market price is, regardless of how much it costs. With silver running from $72 to $75 to potentially $80 or higher, any bank that's been shorting silver, betting that prices would go down or stay flat, is now facing catastrophic losses. And $17 billion in emergency Fed liquidity suggests those losses are big enough to threaten the stability of major financial institutions. Now let me show you why the $15 gap is so significant beyond just the dollar amount. China accounts for more than half of global industrial silver demand, making local shortages a global issue. Chinese spot and futures markets have traded at persistent premiums to London and COMEX benchmarks. In some cases, contracts briefly moved into backwardation, a sign of immediate supply stress. Backwardation is when the spot price for immediate delivery trades higher than the futures price for delivery months from now. That's backwards. In a normal market, futures prices are higher than spot because of storage costs, insurance, and time value of money. When that flips, when people are willing to pay more for silver today than for a contract promising silver 6 months from now, that's a screaming signal that there's not enough physical metal available right now. And it's not just backwardation. Silver has extended into backwardation in China even with $7 to $15 premiums to COMEX futures prices as the immediate demand for physical silver metal reaches acute stress. Think about that. Even paying $15 more than the global benchmark, Chinese buyers still can't get enough silver. The premium keeps rising because supply simply isn't there. Here's what really concerns me and why I think this situation is reaching a breaking point. As China's industrial and investment demand dominates global consumption, over 50% in some estimates, sustained Shanghai premiums could pull global physical pricing higher, forcing COMEX and London benchmarks to catch up through arbitrage or forced deliveries. That's Wall Street speak for something much simpler. If China keeps paying $90 while COMEX shows 75, eventually one of two things happens. Either COMEX prices get dragged upward to match physical reality, or COMEX stops being relevant as a price benchmark and the world starts using Shanghai prices instead. Both outcomes are catastrophic for Western financial markets. If COMEX prices gap up $15 or $20 suddenly to match Shanghai, every bank and institution that's short silver faces instant massive losses. Margin calls cascade through the system. Some institutions fail. But if COMEX prices stay artificially low and the world stops using them as a reference, then the entire Western commodities derivatives market loses credibility. Trillions of dollars in contracts become worthless because they're priced off a benchmark that doesn't reflect physical reality. Here's the impossible position bullion banks and exchanges find themselves in. On one side, they can try to keep suppressing COMEX prices, flooding the market with paper shorts to keep Western prices pinned under $75 or $80. But if they do that while Shanghai runs to 90, 100, 110, eventually the entire world stops using COMEX as a price reference. Central banks start settling at Shanghai prices. Mining companies price their output based on physical markets. COMEX becomes irrelevant. But if they let COMEX prices gap upward to catch Shanghai, here's what happens. Western futures rocket toward China's price and instantly stress every under-collateralized bullion bank, swap book, and over-the-counter contract tied to low silver prices. A $15 or $20 upward gap, multiplied across hundreds of billions or trillions of dollars in leveraged derivatives positions, wipes out institutions. We've seen this movie before. Long-term capital management nearly took down the financial system in 1998 because of leveraged bets that moved against them. What happens when decades of accumulated silver short positions suddenly face a gap up to match physical reality? And we're already seeing them try to manage this. Let me show you the evidence of market manipulation or risk management, depending on how you want to frame it. Throughout 2025, the CME has raised margin requirements multiple times to cool silver's rally. In December alone, margins went from around $20,000 to $25,000 for a single silver contract. That's a 25% increase in the amount of money you need to hold a position. Why would the exchange suddenly make it more expensive to participate right when prices are breaking out and the China gap is exploding? The CME's decision is seen as another attempt to control silver's price during a period of increased demand. Critics argue this is a form of market manipulation designed to benefit short positions while stifling price discovery. When exchanges change the rules in the middle of the game, raising the cost to hold long positions, that forces smaller traders out and suppresses buying pressure. It happened in 1980 when the CME introduced Silver Rule 7, drastically increasing margins and forcing the Hunt brothers to liquidate, crashing prices 50%. It happened in 2011 when the CME raised margins 5 times in 9 days, causing a 30% silver crash. Now in December 2025, they're doing it again. But here's the difference. In 1980 and 2011, there wasn't a $15 physical premium in the world's largest consuming market. The shortage wasn't this severe. The industrial demand wasn't this locked in. So margin hikes might slow the paper price rise temporarily, but they do nothing to address the physical shortage driving the China premium. Let me show you what investors should actually be thinking about right now. Investors favoring allocated physical silver such as bars or coins over paper exposure may benefit as real-world scarcity reprices the metal upward, especially if industrial demand from green technologies, AI, and medical remains strong. Physical silver, the metal you can hold or store in a fully allocated vault where you own specific identified bars, is priced at the Shanghai rate when supply gets tight, not the COMEX rate. If you're buying silver now, the question isn't just whether to buy. It's whether you're buying paper claims at $75 or physical metal that's effectively priced at $90 in the world's largest market. That $15 difference exists for a reason. It's the market telling you that paper and physical have diverged, Scarcity is real, and the paper price doesn't reflect the cost of actually obtaining metal. The CME's actions such as raising margins have little effect on the actual availability of physical silver. The real concern for traders and investors is the increasing shortage of the metal, which will likely continue to put upward pressure on prices. As demand for physical silver remains strong, the gap between COMEX prices and physical prices could widen even further. Now let me address something critical. Could this gap close the other way? Could China prices fall back to meet COMEX? Theoretically, if Chinese industrial demand suddenly collapsed, if massive new supply appeared, if someone discovered a substitute for silver in solar panels and electronics, yes, the gap could close downward. But look at the fundamentals. The backwardation in China's silver market has caused sharp price swings and increased volatility in Shanghai silver trading. Silver lease rates have spiked, indicating a tight lending pool for physical metal. The situation has also spilled into global markets with COMEX silver futures showing some sympathetic price movements. For now, the Shanghai premium over COMEX has remained firm, suggesting that physical imbalances are likely to persist into 2026 unless new supply or policy interventions emerge. Everything in the data says this premium isn't going away. China's renewable energy push is locked in by government policy through 2030. Electric vehicle production targets are mandated. Solar panel manufacturing capacity is expanding. The demand is structural, not speculative. And supply can't respond quickly even at $90 prices. Here's what I think is the most important takeaway from all of this. The $90 China price versus $75 COMEX price gap is more than a commodity market story. It's a signal about the end of Western financial dominance in commodity price discovery. For decades, London and New York set global commodity prices. COMEX for silver, LBMA for gold, NYMEX for oil. The entire world used these benchmarks because that's where liquidity was, where price discovery supposedly happened most efficiently. But we're now watching the emergence of genuine physical price discovery in the East, driven by real industrial demand, and it's diverging violently from Western paper pricing. When physical silver in China trades at $90 and paper contracts in New York show $75, which price matters to the real economy? The answer is obvious. The physical price matters. And if Western paper markets cannot or will not reflect that physical reality, those markets lose relevance for actual price discovery. They become side bets, casinos where speculators play, but not markets where real producers and consumers transact. This has massive geopolitical implications. China has been working for years to establish alternative commodity pricing mechanisms, to reduce reliance on dollar-denominated contracts, to shift price-setting power from west to east. The $90 Shanghai silver price isn't a policy announcement or a political statement. It's raw industrial demand meeting physical scarcity. Chinese manufacturers are willing to pay $15 more per ounce than COMEX quotes because that's what it actually costs to obtain real metal. And as more industrial production shifts to Asia, as more commodity consumption happens in the East, price discovery inevitably follows. The question for Western financial markets isn't whether this shift happens. It's happening right now as we speak. The question is what happens to COMEX, to the LBMA, to trillions of dollars in derivatives when the world stops trusting those benchmarks. We might be about to find out. The liquidity vacuum created by this situation suggests the silver market is in a highly volatile phase. Traders and investors must be prepared for potential price swings as the market adjusts to these changing dynamics. The ongoing disconnect between paper silver and physical silver could lead to more instability in the coming weeks and months. Before we wrap up, I want to hear from you. Are you watching this China COMEX gap? Did you check the prices when I asked at the beginning? What do you think happens next? Does COMEX gap up to match China, or does Shanghai keep pulling away? Drop your thoughts in the comments because I read every single one, and this conversation matters. And here's my ask. If you found this analysis valuable, if you learned something about what's actually happening in silver markets beyond the hype, hit that like button and share this video with 3 people you know who care about markets, investing, or what's happening in the global financial system. This information is too important to keep to yourself. And if you haven't subscribed yet, subscribe now and turn on notifications. We're covering the real stories, the price action that matters, the structural shifts that mainstream financial media either doesn't understand or deliberately ignores. I'll see you in the next video where we'll track whether this gap continues widening and what the breaking point looks like for Western commodity exchanges. Until then, stay informed, pay attention to the physical markets, and remember, when paper and physical diverge this dramatically, one of them is lying. And it's not the physical price. This video is for educational and informational purposes only and should not be considered financial or investment advice. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions.